The housing market is currently experiencing a breakthrough, and it's not what you may expect. Everyone is keeping an eye on interest rates. Everyone is anticipating a decrease in pricing. However, while that is happening on the surface, a much larger issue is subtly creeping throughout this nation from city to city. The rate of mortgage default among homeowners with 780 credit scores, the safest borrowers in America, has increased by more than 300% in the last year alone. These purchasers are not careless. Despite doing everything correctly, these individuals are still failing. 1 out of every 145 homes in Lakeland, Florida, is facing foreclosure. There is pressure on Cape Coral, Jacksonville, Cleveland, and even Washington, D.C., which recently had the biggest inventory spike in that market following the layoffs of tens of thousands of federal employees. However, nearly no one is realizing that mortgage rates are not the driving cause behind all of this. It's what occurs once you purchase the home. The annual hidden costs of homeownership have recently surpassed $16,000. In just 5 years, insurance has increased by 70%. Additionally, Fannie Mae and Freddie Mac recently subtly altered the regulations regarding the type of insurance you actually require, and the rationale behind their actions reveals just how dire the situation has gotten. According to the Mortgage Bankers Association's Q4 2025 survey, the total delinquency rate was 4.26%. That figure may not seem concerning on its own, but here's what makes it unique. In 2025, delinquencies increased concurrently for the first time across the 3 main loan categories: conventional, FHA, and VA. Together, the 3 are heading in the wrong path. It's been years since that occurred. FHA loans are getting hit hardest, with delinquencies at 11.52%, the highest since 2021. But Vantage Score credit data shows this isn't staying at the bottom of the credit ladder. Delinquencies went up across every credit tier: subprime, near prime, prime, and even super prime. That 300% surge mentioned at the top, that was borrowers scoring 781 to 850, the very best. A credit score doesn't measure your savings account balance. It doesn't measure whether your property taxes just jumped $200 a month. It only tells you whether you've been paying your bills on time until now. And right now, people who have paid on time their entire lives are hitting a wall because everything around a mortgage payment got more expensive all at once. Adam's year-end report showed over 367,000 properties with at least one foreclosure filing in 2025, up 14% from the year before. Bank repossession specifically, where the lender actually took the house back, rose 27%, but the annual figure undersells the real story. December 2025 alone saw filings jump 57% year over year, and January 2026 continued the trend. That 11 straight months of annual increases, and the pace is accelerating. Florida is ground zero. Lakeland has the worst foreclosure rate in the country at 1 in 145 homes. Cape Coral is 1 in 189. Jacksonville 1 in 200. Orlando 1 in 217. The state overall sits at 1 in every 230 homes, the highest in the nation. Cleveland has the worst rate among any metro over 1 million people and the highest zombie foreclosure rate in the country, with nearly 10% of foreclosed homes sitting vacant and unmaintained. Chicago led the nation in bank repossessions. Las Vegas is at 1 in 210. Manhattan hit a 15-year high. The Bronx jumped 35% in a single year. And Washington, D.C., after 120,000 plus federal job cuts, saw a housing inventory surge over 60%, with suburbs around Gaithersburg and Frederick seeing unsold homes spike 68%. In less than a year, one of the most stable housing markets in the country became one of the most distressed. When people talk about what's wrong with housing, it's always mortgage rates and home prices. But the real crisis, the one pushing even financially stable homeowners past the breaking point, is the cost of keeping a house after you've already bought it. Zillow pegged the total hidden cost of homeownership at $16,000 a year, covering maintenance, insurance, and property taxes. Those costs have risen 76% since 2017. If your income went up 20% over that period, you're doing better than most people, but your carrying costs nearly doubled. Eventually, the math catches up. Insurance is the single largest motivator. According to a research published by the Dallas Federal Reserve, premiums have increased 70% nationwide since 2019. The average homeowner in Florida spends more than $8,300 annually. It ranges from $15,000 to $22,000 a year in some areas of South Florida. And since 2022, at least 10 insurers have either fled the state or filed for bankruptcy. Homeowners in the highest insurance cost group are at least 22% more likely to fall behind on their mortgage, according to research by Intercontinental Exchange. The Dallas Fed predicted that future insurance increases alone would result in an additional 203,000 delinquencies annually. Because they are unable to pay their mortgage, people are not defaulting. They are in default because they are unable to pay their mortgage and all of the additional expenses. HOA fees in South Florida went from $567 a month in 2019 to $900 in 2024. Miami-Dade high-rise condos now average over $1,900 a month in HOA fees alone, essentially a second mortgage. After Surfside structural reform laws, condo owners are being hit with special assessments running into six figures. HOA-related foreclosures jumped 50% nationally in 3 years. 7 of the 15 worst price decline cities in America right now are in Florida. This isn't just a market correction. It's the entire cost structure of owning a home in that state collapsing on people. On March 18th, the FHFA reversed a major insurance rule. Previously, borrowers with Fannie or Freddie Mac mortgages, about 70% of all U.S. mortgages, were required to carry full replacement cost insurance, meaning if your house was destroyed, insurance would pay to fully rebuild it. That requirement is now gone. Borrowers can use an actual cash value policy instead, which is roughly 25% cheaper. Here's the cruel irony. This only applies to conventional loans. FHA borrowers are governed by HUD's separate requirements and are locked out entirely. The borrowers who need relief the most, lower-income buyers, first-time buyers, people with smaller down payments already crushed by rising premiums, get nothing. And for those who do qualify, the trade-off is going unmentioned. An actual cash value policy pays the depreciated value of what was damaged. If a hurricane takes off a 15-year-old roof, you're not getting a new roof. You're getting what a 15-year-old roof is worth. The gap between what insurance pays and what rebuilding actually costs can exceed $10,000. Fannie Mae's own previous internal analysis warned these cheaper policies could lead to incomplete repairs, increased debt, and home abandonment after disasters. What the FHFA has done is lower the short-term cost and shift the long-term risk entirely onto the homeowner. Everything described above has already played out in Canada, and what's happening there is a preview of what heads our way next. Most Canadian mortgages reset every 3 to 5 years. Roughly 60% of all outstanding Canadian mortgages, over 1 million fixed-rate loans worth $300 billion, were locked in when rates were 1 to 2%, and are now renewing at 4 to 5%. The average payment increase is 20%, with some borrowers seeing 40% or more. Near-prime delinquencies surged 31% nationally and 55% in Toronto and Vancouver. Equifax Canada described it as financial stress rapidly spreading from subprime into the established middle class. Canada's banking regulator warned that up to 150,000 borrowers may not be able to refinance over the next 2 years. Americans have 30-year fixed mortgages and are largely protected from that specific reset shock. But the same kind of payment shock is already hitting hundreds of thousands of Americans right now. Homeowners who took out adjustable rate mortgages 7 to 10 years ago, when rates were low, are now hitting their first adjustments. The 5-1 ARMs from 2016 have been adjusting for years. The 7-1 ARMs from 2018 and 2019 are resetting now. ICE data shows 328,000 ARM borrowers have already passed their initial fixed rate period and are actively adjusting in a dramatically higher rate environment. Someone who locked in at 3.5% could now be sitting at 7% or 8%, a payment shock that stacks directly on top of insurance increases, tax hikes, and HOA spikes, all compounding at the same time. New ARM usage just hit its highest level since 2008, with 21% of new mortgage originations now adjustable rate. These borrowers aren't choosing ARMs out of confidence. They're choosing them because it's the only way to afford the payment. That's not optimism. That's desperation dressed up as a mortgage product. housing affordability just hit its worst level ever recorded. The Atlanta Fed shows 47% of median household income is now required just to own a median price home, against a standard threshold of 30%. The price-to-income ratio nationally sits at 5-1, matching the 2006 pre-crisis peak. The NAB calculates that 75% of American households cannot afford a median-priced new home. Renting is cheaper than owning in all 100 of the largest U.S. metros. First-time buyers fell to just 21% of all purchases, the lowest since tracking began in 1981. The median age of a first-time buyer is now 40. It was 28 in 1992. In almost 100 metro areas, home prices are already declining. Austin's decline from its peak is more than 23%. 20% decline in Cape Coral. Oakland is down 24%. All throughout the Sun Belt, inventory is rising. Miami is up 40%, Raleigh is up 54%, and Las Vegas is up 43%. It's not 2008. The total number of foreclosures is still 87% lower than it was in 2010. There are much stricter lending requirements. The majority of current homeowners have 30-year fixed rates that are historically low. However, we are going through a different kind of breaking point. It is a carrying cost problem rather than a credit catastrophe. While everything else continued to rise, the mortgage payment remained unchanged. Additionally, the entire cost of ownership has become unaffordable for an increasing proportion of homeowners, even those with great credit. Sellers will be compelled to lower their prices in order to shift their homes as long as carrying costs continue to rise. In such marketplaces, the winners are those who recognize what was going on before anyone else did.